In this example video, we're going to look at review exercise 14-12. So it tells us that the Nolan Corporation has outstanding convertible bonds with a face value of $15,000 and a current book value of $17,500. Each $1,000 bond is convertible into 25 shares of common stock that have a $5 par value per share. All the bonds were converted into common stock when the market value of the common stock is $50 per share. And we're going to actually be using the book value method to prepare this journal entry to record the conversion. In this situation, there was no allocation done when the bonds were actually issued to look at the difference between the bond value and the shares value. The reason for that is this is not an and situation, it's an or situation. You will either be a bond holder, or if you convert your bonds into shares, you will be a shareholder. So it's one or the other rather than both. So we're going to be using the book value method, which basically means we're going to be transferring the book value that we have for the bonds on our books currently into equity value onto our books. So we're just kind of doing a swap, if you will. So what we need to get rid of is our bonds payable. And our bonds payable has a face value of $15,000, so it comes off our books at $15,000. They told us that the carrying value, however, was $17,500, which means that there's an unamortized premium. The carrying value is higher than the face value. So our premium on bonds payable has to be removed off of our books for the remaining amount, which is that $2,500. What the people get in return, the bondholders then become stockholders. So they're going to get common stock. And remember, the rule with common stock is it can never be credited for more than its par value. So we have 15 $1,000 bonds. Each one of them is convertible into 25 shares of common stock, and the par value of that common stock is $5 per share. So that means we have $1,875 going on into our equity account of common stock. The difference then between how much of value we had on our books for our liabilities in terms of our bonds and is going to be transferred into that additional paid-in capital account from bond conversion. So it's simply the difference between the value that we had on our books for the liability and how much of that we've already allocated to the common stock account. So in this case, $15,625.